Hello, I welcome you all to my new presentation. This is on dismantling cost. And dismantling cost is an asset retirement obligation. And this has to be maintained through IAS and IFRS. We are going to talk about this dismantling cost in detail. So, think of a oil rig or a mining or a tall tower. These are all non-current asset, and at the end of its useful life the company can just throw it away. It has to restore the land or the possession as it was before. So here is a point comes dismantling cost, and our dismantling cost involves mostly two standards. One is IS 16, which deals with property, plant and equipment. And according to IS 16, the dismantling cost is the part of initial cost of the asset. That is, initial asset cost should be purchase price plus direct cost and present value of dismantling cost. So we have to find the present value of dismantling cost, and we have to add it with our initial asset cost. And according to IS 37, it deals with provisions, and IS 37 directs us to make and measure some provisions. And now we think of example, that is, a company buys a machine for $1 lakh, and it also estimates that dismantling in 5 years will cost 25,000. So the present value of that obligation may be 20,000, and in initial recognition we will debit non-current asset machine 1,20,000, cash credit 1 lakh, and provision for dismantling, this will be 20,000. And at the end of the year we have to unwind the discount. That is, we have to make a finance charge uh, with a discount of cost of capital, and we have to make the increase the provision for dismantling. And there are also depreciation charge. The depreciation charge will be on total value of asset, that is initial cost with present value of dismantling cost. Our charge is here depreciation expense debit and accumulated depreciation credit. Now when dismantling happens, use the provision to pay any extra if costs are higher than charging the profit or loss. If costs are lower, take in another income to the profit or loss. So this is simple. And disclosure, where at the end of our presentation, so we have to disclose the nature of the obligation, the timing of the cash outflow, any uncertainties, and possible reimbursements. So why this is important to account for dismantling cost? This immediate accounting obligation, and in IAS 16 it tells us to include to the asset cost. In IAS 37 makes sure that we recognize a liability, and investors and stakeholders clearly want to see the real impact of dismantling cost. So that's it. Thank you for watching this video.